Today we want to go through our step-by-step guide for beginners wanting to invest $500 in the stock market. So here it is. Open a brokerage account. Buy a total stock market ETF. Done. Okay, just kidding. We will get into the details, but this is basically the gist of it. Make sure to stay until the end for some bonus information specifically for beginner investors. But before we get into it, if you like the content in this video, remember to give us a like and hit the subscribe button. We make new content every week. Disclaimer: we are not financial advisors, we just are regular people sharing information that we live by. We share this information for entertainment purposes only. Please always do your own research and consider consulting a licensed financial professional about your specific situation before investing. Know that all forms of investing, trading, and savings in the stock market, there is a degree of risk. There is no guarantee that you will not lose money, and by investing you are taking on that risk. With this being said, we are conservative investors given our age and attempt to provide value information to you. With that out of the way, let's get started with a couple rules of thumb. When investing, the rule of thumb is to only put money in that you do not anticipate using in the next 5 to 10 years. This is not your emergency fund. Your emergency fund is in a separate account kept in cash to use for an emergency. When you invest, you have the intention to put money into an account and let it sit. We personally go with the buy and hold strategy. With this strategy, we buy stocks and forget it. We have no intentions on selling anytime soon, even through recessions or dips in the stock market. The second rule of thumb we want to talk about is that your losses in the stock market are not realized until you actually sell your investments. This means, even if the value of your stock is lower than what you bought it for, you haven't actually lost money yet. You lose money when you actually cash out. For example, let's say there are two investors. Both investors bought a stock for $100. The market dips and the market value of that stock is now $80. Investor A decides to continue in her buy and hold strategy, while Investor B panics and sells the stock at $80. The stock continues to drop to $50. But Investor A still holds the stock. Within 8 weeks, the stock recouped its value and is now worth $120. Investor A spent $100 and now has a stock at the market value of $120, while Investor B has no stock, spent $100 and now has $80 in cash. So who do you want to be? We bring this up because when investors see their stock portfolio dropping, they panic and then they sell. They sell out because they don't want to lose any more money. However, in reality, no money is actually lost until the investor hits the sell button. In the example earlier, even though Investor A's stock went down to $50, she still ended up with a stock worth $120 at the end of the day. Given the stocks we talk about in this video, the likelihood of recovering a dip or a recession is very good. If you look at the last 100 years, the market has always recovered and is hitting record highs consistently. Next up, let's go over a little bit of background information. You will open your account with a brokerage firm. A brokerage's main responsibility is to be the middleman between the stock market and you. They bring together an agreed upon price for ETFs, mutual funds, stocks, and bonds between the buyer and seller. There are literally thousands of brokers in the United States. Some of the lowest cost and most user-friendly are M1 Finance and Vanguard, and these are the ones that we choose to use. Generally speaking, you can choose between a retirement account and an individual brokerage account. A retirement account or an IRA grows tax-free, but you cannot access it until you're 60 years old, unless you do some fancy financial footwork we won't get into in this video. With an individual account, if you take out your gains, you will pay taxes, but if you don't take any money out, you won't. For simplicity's sake, we are going to focus on the individual account for this video. Anyone can open an individual brokerage account if you're 18 years old. So the first step is to pick your brokerage firm and then taking the plunge to open the account. You're going to have to enter some basic information about your name, birth date, address, bank information, social security, etc. Enter that in and choose your account type. As a beginner, consider an IRA or individual account. Each have different tax implications. Once you have chosen your account type, you have your next big decision to make: what investment to buy. One of the simplest and lowest risk strategies is to buy a total market ETF. An exchange-traded fund, abbreviated to ETF, is a basket of stocks that tracks an underlying index. An index is a list of companies that share something in common with each other. They represent a segment of the market. These indices can be the Dow Jones, the S&P 500, the energy sector, information technology sector, the list goes on and on. Some of these indices have companies you are very familiar with. For example, Apple, Disney, Google, Microsoft. But the job of the ETF is to allow investors to easily invest in one of these indices. In the case of the total stock market ETF, you are buying into the entire stock market. This is the easiest way to diversify your portfolio. Instead of buying into one stock like Disney or Apple, you are buying the entire stock market. This helps you mitigate risks associated with going all in on a specific company. So if you're still with me, comment "I'm still with you" down below. So how do you invest $500? Well, when you buy an ETF, you're buying a very small fraction of those companies on the list. A couple of our favorite ETFs are from Vanguard because they have a very low expense ratio. The expense ratio is what Vanguard takes from the investment to help cover the costs to operate. We like VOO because it tracks the S&P 500. VIG because it invests in dividend growth companies, and we like VGT because it invests in the information technology sector. When you go to buy an ETF, you have to take a look at their current market price to see how many shares you can buy with your $500. With the ETFs listed above, you will be able to buy about 1 to 3 shares depending on the price. You can do a combination of them as well. Okay, if you made it this far, here are some bonus tips. Bonus tip number 1. Slow, steady, and consistency win the race. Slow, steady, and consistent are the best tools you can have when investing. This is not a get-rich-quick scheme, but rather a slow and reliable method to grow wealth over time. It is best to be as consistent as possible. Timing the market is not the way to go. Bonus tip number 2, don't stock watch. Consistently watching the stock market and your portfolio is an emotional roller coaster. Commit to the buy and hold strategy and accept that the market will swing up and down over the course of time. Check periodically, but every few hours is definitely not necessary. Before you even know it, 10 years will have passed and a compounding interest and gains in your underlying investments will make you forget about all those market swings of the past. Okay, so there's our step-by-step guide for beginners looking to invest $500 into the stock market. Now it's time to take action. First, research brokerage firms and pick the right one for you. Then, open an account and contribute $500. Pick the right ETF, stock, or mutual fund that you think will be the best for you, and then buy that ETF, mutual fund, or stock, and you're done. It can be difficult to start, but your future self will thank you for doing it. If you enjoyed the content in this video, make sure to subscribe to us and tell us about it. Do you want more information about investing for beginners? Let us know in the comments. As always, thanks for watching. We look forward to seeing you in the next video.